Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, welcome. Have you ever just stopped and wondered why so many really smart people seem to get absolutely nowhere in the stock market? Well, today we are diving deep into the secrets from Hans Noren's book, How to Invest Like the World's Greatest Investors. We're going to pull back the curtain on a strategy that's, believe it or not, pretty simple, but it has consistently built fortunes by doing one thing: going against the crowd.
So let's just kick things off with this absolute classic from J. Paul Getty. This quote, it really nails the radical idea we're talking about today. I want you to picture this. You're in a crowded theater and somebody screams fire. What happens? The herd, they just stampede for the exit. The contrarian investor, though, that's the person who just calmly stands up and checks to see if there's actually a fire before they make a move. See, it's all about using your head when everyone else is losing theirs. And that, right there, is the heart of value investing.
And this leads us right back to that central question from the book. I mean, it's a frustrating reality, isn't it? You see these incredibly brilliant people, we're talking doctors, engineers, you name it, and they just can't seem to get ahead in the market. So what's going on? Well, it's not about a lack of intelligence. The book argues it boils down to something much more fundamental.
And here it is. This is the paradox at the core of successful investing. It's shockingly simple, but at the same time, it's incredibly difficult to pull off. First, you've got to have a proven strategy, one that has worked for decades, not just the latest hot trends you saw online. But second, and this is the part where almost everyone stumbles, you need the discipline of a soldier to stick with that strategy, especially when your own emotions and all the screaming headlines are telling you to run for the hills.
Okay, so here's our game plan for this explainer. We're going to start with the big dilemma investors face. Then we'll decode some common market myths that trip people up. After that, we'll open up the Value Investors Toolkit, take a little masterclass from Warren Buffett himself, and then we'll tackle the mental game, which is huge. Finally, we'll put it all together so you can start building your own strategy.
First up, let's decode some market myths. Think of this part as clearing the land before you build a house. We have to tear down all the faulty ideas that lead so many good people astray. Because honestly, learning what not to do is every bit as important as learning what you should be doing.
So, in the world of stock analysis, you basically got two main camps. On one side, you've got fundamental analysis. This is all about digging into the business itself, its financials, its health, its debt. You're basically being a detective for that company. And on the other side, you've got technical analysis, which completely ignores the business and instead tries to predict where the price is going just by looking at old chart patterns.
Now, the book's position on this is, well, it's direct. It's unapologetic. It flat out argues that trying to predict the future based on a bunch of squiggly lines on a chart is a complete and total waste of time. Look, it might be popular, and you'll find countless gurus out there selling you this dream, but in the real world, it's a dangerous distraction from what really matters, the actual health and value of the business you're buying.
And if you need more convincing, just look at this number. It perfectly shows how absurd prediction is. The odds of a professional Wall Street analyst getting a company's earnings right for just 5 years in a row are 1 in 50 billion. You literally have a better chance of winning the lottery twice. So if the super high-paid experts can't do it, why on earth would we bet our hard-earned money that we can?
Then you have this idea, one that's taught in pretty much every business school, the efficient market theory. It says the market is this all-knowing entity, and every stock price is always perfectly correct. But the book poses a really simple, powerful question. If that's true, then how do you explain massive market bubbles and spectacular crashes? The theory just completely falls apart when it meets reality.
Okay, so if we're throwing out technical analysis, we're throwing out forecasting, and we're skeptical of this whole perfect market idea, what are we left with? Well, this brings us to the core of it all, the Value Investors Toolkit. These are the practical, time-tested tools that the greats actually use.
This quote from Warren Buffett, this is the North Star for every value investor. It's probably the single most important idea you need to get your head around. Think about it like this. The price is just the sticker on a car at the dealership. It can change day to day. The value is the car itself, the engine, its reliability, its safety. Our goal is simple. Buy a fantastic car for way less than what that sticker says.
So how do we start finding these bargains? Well, one of the first tools in the kit is the PE ratio. It's a really quick way to see what the market is expecting. A high PE means everyone is betting on huge growth, which, as we just saw, is really hard to predict. A low PE, though, that can be a signal that a company is unpopular, out of favor, and maybe, just maybe, undervalued.
It's the perfect starting point for your detective work.
And this is a classic from the godfather of value investing, Benjamin Graham. It's the ultimate safety-first approach. Imagine a company just goes out of business tomorrow. You figure out how much cash you'd get if you sold off all its easy-to-sell stuff, like cash in the bank, inventory. And then you paid off every single debt it has. If the company's total stock price is less than that pile of cash left over, you're literally buying $1 for 50 cents. It doesn't get much safer than that.
Now, buying right is only half the battle. You have to know when to sell, and that's just as critical. The key is to be disciplined about it, not emotional. You sell when the market finally catches on and the price reflects its true value. Or maybe if the company does something that fundamentally changes the business, like a bad merger. The main point is, you can't fall in love with a stock. You should only be in love with its price.
So Benjamin Graham gave us the foundation, right? But it was his most famous student, Warren Buffett, who took those ideas and just built a skyscraper on top of them. Buffett really evolved value investing from just buying cheap, beat-up companies to buying wonderful companies, but at a fair price. It's a subtle but huge shift.
Buffett has this brilliant way of simplifying the entire business world into just two buckets. On one side, you have commodity businesses. Think of an airline. They sell a product that's really hard to make different, so they have to compete like crazy on price. It's a tough, brutal business. But then, on the other side, you have franchise businesses, like Coca-Cola. They have a brand or a product that's so powerful, it acts like a moat around them, protecting them from competition and giving them the power to name their price.
And this toll bridge analogy, it's just the perfect way to understand a franchise company. The absolute best investment you can find is a business that owns an essential bridge that everybody has to cross. Customers have no other choice. They have to use it and they have to pay the toll, which guarantees this reliable, ever-growing stream of cash for you, the owner.
So how does he find these toll bridges? Well, Buffett uses a special set of financial X-ray goggles. He looks right past the reported profits to find three things. First, intrinsic value. What's the business truly worth deep down? Second, owner earnings. This is the real cash the business generates for its owners, not some accounting trick. And third, a high return on equity. That's just a fancy way of asking, is this business unbelievably good at turning $1 of investment into even more dollars of profit?
Now listen, you could have all the best tools, all the right formulas in the world, but without the right mindset, they are absolutely useless. And that brings us to what might be the single most important section here, winning the mental game. Because this, right here, is where most investors fail.
This is it. This is the ultimate contrarian mantra. You have to understand that the stock market is basically a manic-depressive machine. It swings wildly between total euphoria and absolute despair. The intelligent investor doesn't get swept up in that. No, they use it. Widespread fear? That creates bargain prices. That's when you get greedy. Widespread greed? That creates dangerous bubbles. That's when you get fearful.
And if you think this is some new thing, just take a look at this timeline. It doesn't matter if it was people going crazy for tulip bulbs in the 1600s or for dot-com stocks with zero profits in the late 90s, the story is always the same. The details change, but that human psychology of fear and greed, it is a constant. As they say, history doesn't repeat, but it sure does rhyme. Your job is to recognize the rhymes.
So how do you protect yourself from all this madness? Well, first, just turn off the noise. Stop watching the financial news channels all day long. They're literally designed to make you panic. Second, you have to think for yourself. Do your own homework and trust your own analysis, not the crowd's. And third, be incredibly, incredibly patient. Investing is like being a baseball hitter who gets to wait for the perfect pitch. You don't have to swing at everything. You can just wait for that one perfect opportunity.
Okay, we have covered a ton of ground. We've debunked myths, we've learned the tools, studied the masters, and talked about taming our own psychology. Now, it's about putting it all together. See, the goal isn't to be a perfect carbon copy of Warren Buffett. The goal is to use these timeless principles to develop your own judgment, your own style.
And we're going to end with this powerful question from the book. You see, the secret to winning this game isn't about having a crystal ball. It's about knowing something that the emotional, panicked crowd doesn't. And after this explainer, you know that risk isn't just a bouncy stock price. You know that trying to predict the future is a fool's game. You know that market emotion is an opportunity, not a guide. And most importantly, you know the difference between price and value. That is your edge. So the only question left is, how are you going to use it?
Have you ever just stopped and wondered why so many really smart, successful people seem to get absolutely nowhere with their investments? It's a real head-scratcher, and honestly, it's frustrating. It almost always comes down to following some deeply flawed advice. So today, we're going to pull back the curtain and break down the common myths that lead to those just mediocre returns.
You know, this quote from George Santayana, it couldn't be more true when you talk about money and finance. It really feels like when it comes to investing, we're all just stuck on this giant hamster wheel, repeating the exact same expensive mistakes generation after generation.
So let's just put the question right out there, plain and simple. You're smart. You work incredibly hard for your money. So why does the stock market so often feel like a game that's rigged against you? A game that just delivers these disappointing, mediocre, or sometimes even terrible results? Well, it turns out that a lot of what we've been taught about investing is just fundamentally wrong. All right, our first stop on this myth-busting tour is probably one of the most popular, and I've got to say, one of the most misleading corners of the market. Let's talk about this world of charts, squiggly lines, and the seductive promise of predicting the future by looking at the past.
Okay, so when people analyze stocks, they generally fall into two big camps. On one side, you have fundamental analysis. This is all about digging into a company's actual financial health. You know, its sales, its profits, its debt, the real stuff. And then you have technical analysis. This completely ignores the business itself and instead tries to predict where the stock price is going just by reading charts of past movements. The whole idea rests on one big assumption, that history is just going to repeat itself.
And this is the kind of stuff you see all the time, right? These ads for technical analysis software, these gurus on the internet promising you just unbelievable results, a 500% return in a single year. I mean, who wouldn't want a piece of that? It sounds amazing. It sounds almost a little too good to be true.
And that's because it absolutely is too good to be true. The dirty little secret behind these mind-blowing claims is that they're almost always created after the fact. It is so easy to build a predictive model that works perfectly when you're looking at past data. Why? Because you already know what happened. It's like confidently placing a huge bet on a horse race that finished yesterday. Of course you're going to win.
So here's the bottom line. Trying to use past price charts to predict the future is, frankly, a massive waste of time. A company, a real business, is a living thing. Its circumstances are changing all the time, and only digging into the fundamentals can tell you what's really going on. Let's just call technical analysis what it is. It's the financial equivalent of using astrology to make your decisions. And yet, believe it or not, people do that too.
All right, so let's move on from the chart gazers and tackle a much sneakier, more, well, insidious idea. This is one that has totally dominated business schools and the entire financial industry for decades. Let's talk about the great myth of efficient markets.
So this idea, efficient market theory, or EMT, has had a huge influence. The core belief is pretty simple. It says that because you have millions of smart people out there analyzing every scrap of public information, a stock's price at any given moment is always the correct and fair price. The market, in theory, is perfectly efficient. And if that's true, then the only way to possibly beat the market is if you have illegal inside information.
But just hold on a second. Take a step back and think about that. This theory has some massive gaping holes in it. If every price is always correct, how in the world do you explain gigantic market crashes like the one in 1987 when the market dropped over 20% in one day? Did all those great companies suddenly become 20% less valuable overnight? And what about those legendary investors who beat the market, not just for a year or two, but for decades? Are they all just super lucky? Or are they all cheating? Of course not. It just doesn't add up.
So, how do the believers in this theory get around these glaring problems? Well, they introduce this idea of risk. They say, sure, you can get higher returns, but you have to take on more risk. But here's the crazy part. They define risk simply as volatility, how much a stock's price bounces up and down. They even created a metric for it called beta. So according to them, the more a stock's price wiggles around, the riskier it is.
And this is where the entire academic house of cards just collapses with one simple question. Let's say you have an opportunity to buy $1 worth of a fantastic business for 40 cents. Then, because of some market panic, the price drops. And now you can buy that same dollar for 20 cents. Has it become more risky? Is it more dangerous to pay 20 cents than it was to pay 40 cents for the exact same thing? I mean, for any rational person, the answer is obvious. It's less risky. You're getting an even better deal. This whole definition of risk is just complete nonsense.
And look, this isn't just some dusty old theory sitting in a textbook. This stuff has real-world consequences. It's the foundation for what's called modern portfolio theory, or MPT, which is a system that armies of financial advisors and fund managers use to build portfolios for their clients. But think about it. When you build your house on a cracked and crumbling foundation, you really shouldn't be surprised when it eventually causes some very real damage.
Okay, let's move on to the next major pillar of modern finance that really needs a serious reality check. We've debunked the chart reading stuff, we've picked apart these flawed theories on risk. Now let's take a hard look at our supposed ability to predict the future. If you turn on any financial news channel today or read any analyst report, you'll notice pretty quickly that their so-called fundamental analysis is obsessed with one thing and one thing only: trying to predict a company's future earnings. The whole game is about forecasting growth, trying to find that next big thing before anyone else. But the real question is, how good are they at it?
Well, the answer is they're not just bad at it. They are catastrophically, unbelievably terrible at it. One massive study looked at the actual odds of a Wall Street analyst correctly predicting a company's earnings over the next 5 years within just a reasonable 5% margin of error. The odds? 1 in 50 billion. Let that sink in. You literally, and I mean literally, have a better chance of winning the Powerball lottery multiple times.
So you have to ask, right? If the results are this laughably bad, why on earth does everyone keep playing this game? Well, it really boils down to two very human reasons. First, there's a powerful fear of going against the herd. In the world of finance, it's often safer for your career to be wrong along with everybody else than it is to be right all by yourself. And second, it's just good old-fashioned over-optimism. We all have this tendency to think we're a little bit better than average at, well, everything.
Okay, we've spent a lot of time tearing down some pretty big myths. We've seen what doesn't work. So now let's start building a solid foundation from the ground up. And that has to begin with understanding a hugely important distinction: the difference between being an investor and being a speculator.
For this, we have to go back to the master himself, Benjamin Graham, the guy who literally wrote the book on value investing. He gave us the clearest, most powerful definition ever. He said, an investment requires two things. First, thorough analysis. And second, it has to promise both the safety of your original money, your principal, and an adequate or satisfactory return. Anything else? Anything that doesn't meet those two strict requirements is just speculation, period.
And this really just lays it all out, doesn't it? It shows the two completely different paths you can take. The investor does the homework. They analyze the actual business, they make not losing money their number one priority, and they aim for a reasonable, sensible profit. The speculator? Well, they're buying based on a hot tip or some hype they saw online. They're just hoping to ride a momentum wave. And the big problem with that strategy is that it almost always ends with them buying high and then panic selling low when that wave inevitably comes crashing down.
So as we start to bring this all together, let's quickly summarize the key lessons here. The kinds of things you probably didn't learn in business school, but the things that are absolutely critical for actual success in the real world of investing.
So let's just hammer these points home. First, remember, real risk is not the stock price wiggling up and down. It's the chance you could permanently lose your money. Second, just forget about trying to predict the future. And please, don't rely on technical analysis. We've already established that's basically financial astrology. Chasing whatever stock is popular at the moment is a fantastic recipe for buying high and selling low. And finally, understand that true, successful investing is about deep, business-like analysis. It's not about complex math or fancy formulas.
Look, we've spent this whole time clearing away the rubble. All the myths, the bad advice, the nonsense that leads so many intelligent people down the wrong path. So the crucial question we're left with is this: now that you know what to avoid, now that you know what doesn't work, the real journey can actually begin. How do you find the strategies that do work? That's the question you should be carrying with you.
You look at the market today, it's just chaos, right? You've got meme stocks flying all over the place, a 24-hour news cycle that never sleeps. It's so easy to feel like investing is just a big casino. But what if I told you there's a rational, time-tested strategy that cuts right through all that noise? Well, there is. It's called value investing. It's a philosophy built not on hype, but on a disciplined search for real, tangible worth. So, how do we make sense of all this chaos? Let's dive in. You really can't talk about this subject without starting with the master himself, Warren Buffett. This one sentence, this is everything. It's what separates a true investor from a speculator. Think about it. Price is just the sticker on the car. Value is the engine, the performance, the reliability, the whole package. The entire goal here is to understand that engine so well that you can confidently buy the whole car for less than the engine alone is worth. It's all about learning how to buy $1 for 50 cents. So you might be wondering, how is it even possible to buy $1 for 50 cents? It's possible because in the short term, the market is completely, utterly irrational. Benjamin Graham, the guy who invented this whole thing, he imagined the market as a business partner he called Mr. Market. Every day, this guy shows up and he offers to either buy your shares or sell you his. Some days he's ecstatic, euphoric, and he'll name a ridiculously high price. But other days, he's in a total panic and he'll offer to sell you the whole shop for pennies. For the value investor, this emotional roller coaster isn't a threat. It's a gold mine of opportunity. And this right here, this just lays it out perfectly. On the left, you've got the short-term price. That's Mr. Market's mood swings, right? It's all driven by scary headlines and herd mentality. But on the right, you have long-term value. That's the anchor. It's the actual earning power, the real assets of the business. And here's the key. Over time, that frantic, bouncing price will always gravitate back towards that solid line of value. Our job as value investors is simply to buy when those two lines are really far apart and then just wait patiently for them to meet again. So where did this whole disciplined approach come from? Well, you can trace it all back to one man, Benjamin Graham. People call him the father of modern financial analysis, and for good reason. He basically took investing from being a gambler's paradise and turned it into a real profession. He literally wrote the Bibles on this stuff, security analysis and The Intelligent Investor. I mean, they're still required reading today. Now, if you only remember one thing from all this, make it this: the margin of safety. It's the absolute cornerstone of Graham's philosophy. It's really an engineering principle, you know? You don't build a bridge to hold exactly the weight of one truck, you build it to hold 3 just in case. It's the same in investing. It means buying a company for way less than you've calculated it's worth. For example, Graham often tried to buy stocks for at least 30% below their book value. And book value is simple. It's just what the company would be worth if it shut down tomorrow, sold all its assets, and paid off all its debts. That 30% discount, that's your bridge. That's what protects you from bad luck, bad timing, and even your own mistakes. Okay, so the theory is powerful. I get it. But how do we actually do this? How do we go out into the wild, into the market, and find these bargains? Well, we need a set of tools. So let's build out a foundational value investor's toolkit with 4 really practical methods you can use to spot undervalued companies. All right, so here are the 4 key tools we're about to put in our kit. We're going to start with the classic PE ratio, just a quick way to find companies the market might have overlooked. Then we'll look at price to cash flow, which focuses on the actual money a business is generating. After that, we'll get into Graham's ultimate bargain hunting tool, the net-net method. And finally, we'll talk about dividends, a way to literally get paid while you wait. First up, the price to earnings ratio. This one is a classic for a reason. See, a low PE often suggests that the market has really low expectations for a company. While everyone else is chasing some hot new tech stock with a PE of like 80, the value investor is over here looking at the boring, forgotten industrial company with a PE of 8. Now, it's not a magic bullet, of course. A low PE for a car company is totally different than a low PE for a software company. But when you see a PE that's low for its industry and low compared to its own history, well, that's your signal. That's your cue to lean in and take a much closer look. Next up, we've got price to cash flow. Here's the thing about earnings. They can be fudged a bit, you know? Accounting rules and fancy assumptions can make them look better than they are. But cash is a lot harder to fake. A company needs real cash to pay its people, to invest in new projects, to handle emergencies. You've heard the saying, cash is king, right? Well, it's true. At the end of the day, cash is what keeps the lights on. So finding a company that's trading at a low multiple of its cash flow means you're buying a resilient business that generates plenty of the one thing it absolutely cannot survive without. Okay, now we're moving on to a tool that's a little more advanced, but it is incredibly powerful. This is Benjamin Graham's signature move, his secret weapon, really. It's called the net-net method. This is the ultimate deep value bargain basement hunting technique. It's designed to find the company's absolute rock bottom liquidation value, what you'd get if the business just shut its doors tomorrow and sold everything off. And you know what's crazy? The calculation is shockingly simple. It's just 3 steps. First, step 1, you take the company's current assets. That's stuff like cash, inventory, things that can be turned into cash pretty quickly. Then, step 2, You subtract all of its liabilities. I mean everything, not just the short-term bills, but all the long-term debt. Every single penny the company owes to anyone. What's left over is its net current asset value. And finally, for step 3, you just divide that number by the number of shares out there to get the per-share liquidation value. That's it. But here's the kicker. This is what makes it so brilliant. Graham wasn't even satisfied buying a company for its full liquidation price. He wanted an even bigger margin of safety. His strict, non-negotiable rule was to only buy if the stock price was 2/3 or less of that net value you just calculated. And he had one more condition. The company still had to be profitable. I mean, think about that. You are literally buying $1 worth of assets for 66 cents or less, and you're getting a functioning, profitable business thrown in for free? That's the definition of a bargain. All right, our final tool is all about the dividend. A stock with a high, stable dividend yield gives you 2 really clear advantages. First, you get a direct cash return on your investment, right into your pocket. It's income. Second, that dividend payment often acts like a cushion when the market starts to fall. It can make the stock more resilient than its peers that don't pay anything. It's a tangible reward for being patient. So now we've got our tools. But just because you have a hammer doesn't mean everything is a nail. Finding a stock that looks cheap on paper is really just the first step. The next part, and this is critical, is to filter for quality. We have to make sure we're not buying what they call a value trap. That's a stock that's cheap for a very, very good reason, and it's probably just going to get even cheaper. So to separate the real bargains from the potential disasters, we're going to apply 2 final common sense checks. First, we'll take a peek at the company's balance sheet just to make sure it's financially sound, especially its debt. And then we're going to step back and do a quick reality check to see if the business is facing, some kind of existential threat. The legendary investor Peter Lynch once said, "A company with no debts can't go bankrupt." And yeah, that's maybe a bit of an oversimplification. Some debt can be a good thing, but it highlights a crucial point. An overwhelming pile of debt is the #1 killer of companies. It can turn what should be a temporary business slump into a permanent lights-out failure. A really great tool for this is the debt-to-equity ratio. It just compares a company's total debt to what the shareholders actually own, the equity. And shareholders' equity, all that is what's left for the owners after you subtract all of a company's debts from all of its assets. Now, as a general rule of thumb, a debt-to-equity ratio of around 50% or 0.5 is usually considered pretty manageable for most companies. It suggests the business has a strong financial foundation. Our second check is less about the numbers and more about, just stepping back and using your common sense. If your analysis shows a company is facing a fundamental crisis, like a new technology just made its main product obsolete, or it's facing a massive lawsuit, or its entire industry is collapsing, you have to be extremely careful. Even if the numbers look good today, you're not really investing anymore. You're just betting on a miracle. The goal is to avoid the obvious train wrecks. Okay, so we spent all this time talking about how to buy, but that's only half the battle, isn't it? A true master of value investing knows that having a disciplined selling strategy is just as critical to long-term success as buying right. Your entry point was calculated and rational. Your exit has to be too. This quote, "This is the exact mindset you need. You bought the stock for logical, analytical reasons. You have to sell it with that same cold, dispassionate logic. The second you start thinking, oh, but I just love this company, you've let emotion into the game. And emotion is the enemy of good investing. You fell in love with the bargain. Once the bargain is gone, the romance is over. Time to move on." So when is it time to sell and lock in a profit? Well, the most obvious reason is you won. The market finally came to its senses, the price shot up, and your margin of safety has vanished. That's a great reason to sell. Another trigger is if the company gets bought out or merges, because that fundamentally changes the business you invested in. Or sometimes the smartest move is to sell a fairly valued stock to free up cash to buy a brand new, deeply undervalued one that offers a way better margin of safety. But what about when things go wrong? This is the hard part, but it's essential. You have to know when to cut your losses. If the company's fundamentals seriously deteriorate, your original reason for buying is gone. It's no longer valid. You have to sell. Another huge reason to sell is simply admitting you made a mistake. If you go back over your research and you find a flaw in your original analysis, the only right move is to sell immediately and protect your capital. Don't let your ego turn a small financial mistake into a big one. And this leads us to the real secret of long-term success. It's not about being some kind of genius who never makes a mistake. That person doesn't exist. The real secret is having a disciplined system that makes sure, over the long haul, that your winning investments are bigger and more frequent than your losing ones. It's all about patiently managing probabilities, not trying to predict the future. And so I'll leave you with this. This is the one question every single investor has to ask themselves constantly. When one of your stocks is down, are you holding on because your original analysis is still sound and you're just patiently waiting for its value to be recognized? Or are you just hoping? Are you engaging in wishful thinking because you can't bear to admit that you might have been wrong? The honest answer to that question, that will probably determine your fate as an investor.
All right, let's talk about a guy who is, without a doubt, one of the richest people on the planet. But here's the crazy part. He lives and works hundreds of miles from Wall Street and basically throws out most of what they teach in business school. So how did he do it? Well, today on The Explainer, we're going to pull back the curtain and unlock the Buffett blueprint. We're going to get into the exact principles that built his massive fortune.
And he kicks things off with this. I mean, this is a pretty provocative idea, right? He's basically saying that all that conventional wisdom they drill into you at business school, the thinking that runs Wall Street, he thinks it's not just useless. It can be a massive disadvantage if you're a serious investor. For him, the real magic, the true insight, it comes from thinking for yourself, not just blindly following the herd.
And look, this wasn't just some abstract philosophy he was talking about. It produced absolutely jaw-dropping results. I mean, his early investment partnership, it didn't just beat the market, it completely annihilated it. We're talking about outperforming the Dow Jones by an average of 22% every single year for over a decade. I mean, a performance like that is so dominant, the entire financial world had no choice but to sit up and pay attention.
So what's the secret sauce here? How did he do it? Well, we're about to walk you through his entire blueprint piece by piece. First, we'll look at the Oracle of Omaha himself. Then, we'll talk about who he learned from, learning from the masters. After that, we dive into the Buffett blueprint, his core strategy. We'll get practical with Buffett's analytical toolkit, then see how he puts it all together in managing the portfolio. And we'll wrap up with what might be the most important part, the investor's mindset.
Okay, let's dive right in with part one. The Oracle of Omaha. And that title is really key here. To get a handle on Buffett's strategy, you have to understand why on earth he operates out of Omaha, Nebraska, and not the center of the universe, New York City.
You see, he intentionally runs his entire empire from Omaha, far, far away from the chaotic noise of Wall Street. And for him, this distance isn't some kind of handicap. He thinks it's his greatest strategic advantage. This quote just says it all, doesn't it? The constant chatter, the hot tips, the nonstop pressure to just do something, anything. He sees all of that as a totally toxic environment. It kills the kind of rational, long-term thinking that's required to actually make real money.
All right, next up, learning from the masters. Because you gotta understand, Buffett's genius didn't just appear out of thin air. It was really forged by combining the philosophies of two of the absolute titans of 20th century investing, Benjamin Graham and Philip Vischer.
And this right here really visualizes the two big kind of competing ideas that he managed to fuse together. So on one side, you've got his mentor, the legendary Ben Graham, the father of value investing. His whole deal was basically find a fair company and okay business, but get it at a wonderful price. They call it cigar butt investing, like finding a discarded cigar on the street with one good puff left in it. But then, on the other side, you have Philip Vischer, who was all about finding wonderful companies at a fair price. And Buffett's real genius was taking these two opposing views and blending them into something totally new and incredibly powerful.
Okay, so this blending of ideas, it leads us right to the absolute heart of the Buffett blueprint, his relentless, almost obsessive hunt for what he calls franchise companies. So in his mind, the business world is split into two very different categories. On one side, you've got your commodity businesses. Think about airlines or oil producers. They all sell a pretty standardized product, right? Which means their only real weapon is price. And that leads to these just brutal price wars where, as he famously said, it's really hard to be smarter than your stupidest competitor. But then, on the other side, you have the franchise companies. Now, these are the crown jewels. These are the businesses with a real, lasting competitive advantage, almost like a monopoly with consumers that lets them call the shots on pricing. You know who I'm talking about: Coca-Cola, Disney, businesses like that.
And this analogy is just perfect for what he's looking for. Think about a toll bridge. It's a fantastic business, right? You've got a monopoly,
It's really hard for someone to build another bridge right next to yours, and it just generates this steady, predictable river of cash without needing a whole lot of extra investment. That, right there, is the very essence of a franchise company.
And here is one of the, let's call it, hidden superpowers of these franchise businesses. Think about it. During times of high inflation, a regular commodity business just gets crushed. Their costs go up, but they can't raise prices because of the competition. But a franchise, that toll bridge, they can just raise the price of the toll. And because customers don't really have another choice, the business acts like this incredible shield, protecting its earnings from getting eaten alive by inflation.
All right, so we know what he's looking for, these amazing franchise businesses. But how does he actually find them, and how does he analyze them? Let's pop the hood and get into the specifics of his analytical toolkit.
First things first, you can just forget about all the complicated stock charts and the economic forecasts. Buffett's toolkit is all about one thing: understanding the business itself. He hones in on just a handful of core ideas, like calculating a company's true intrinsic value, figuring out its real cash-generating power using something he calls owner earnings, checking how profitable it really is, and, really importantly, analyzing how well management uses the profits it makes.
Okay, this concept right here is absolutely crucial. Buffett completely throws out standard accounting stuff like cash flow. He doesn't trust it. Instead, he uses his own, much more honest metric, owner earnings. And it's designed to answer one simple, honest question. After you've paid all the bills and you've spent the money to keep your toll bridge in perfect working order, how much cash can you, the owner, actually take out of the business and put in your pocket? It's just a much more conservative and frankly realistic way to look at a company's true earning power.
Next up, he looks at something called return on shareholders equity, or ROE. And all this really measures is how well a company uses the money its owners have invested in it. So if you look at the historical average for a US company, it's around 12%. But see, Buffett isn't interested in being average. He sets the bar way higher. He's looking for companies that consistently crank out a return of 15% or more.
And this has got to be one of my all-time favorite Buffett quotes. It just perfectly sums up how he thinks about management. Yeah, of course, he wants good leaders, but what he really prioritizes is a business that is so fundamentally strong, so durable, that, like he says, even an idiot can run it. And why is that so important? Because sooner or later, one probably will. For Buffett, the quality of the toll bridge is always more important than the quality of the guy collecting the tolls.
All right, so he's found one of these wonderful businesses and he's bought it at a fair price. So what does he do now? How does he actually manage it inside his portfolio? Well, as you can probably guess, his approach here is just as unconventional as everything else we've talked about.
You know, all you ever hear from Wall Street is diversify, diversify, diversify. Buffett, he does the exact opposite. In fact, he has a great name for it. He calls it diversification. And his logic is really simple. Why on earth would you put your money into your 20th best idea when you could just put more money into your absolute #1 best idea? So he concentrates his bets, he bets big, he thinks in terms of decades, not months, and he has this incredible patience, just waiting for that perfect pitch to come along so he can swing for the fences.
But this brings up a really important question, right? If your plan is to hold some of these companies literally forever, what would it take to make you sell? When is it time to get out? Well, the answer is pretty simple. He's not going to sell just because the stock price looks a little high or because there are scary headlines about the economy. He only sells for two reasons and two reasons only. Reason one, the fundamental business itself is broken. The toll bridge is starting to crumble and it's never going to be the same. Or reason two, he finds an even better toll bridge to own. And that's it. His decision is always about the business, and it's never about the day-to-day squiggles of the stock price.
And that brings us to our final section, which, might just be the most important piece of the entire puzzle. Because all of these techniques, all these formulas, they don't mean much unless they're sitting on top of the right psychological foundation. We're talking about the investor's mindset.
So when he's looking at the people running a company, he's way less interested in their fancy MBA or their resume, and he's way more interested in their mindset. Are they rational people? Are they sincere? Can they admit when they make a mistake? And maybe most importantly, can they think independently and not just follow the crowd? For him, the real acid test is when management takes company cash and buys back their own stock when it's cheap. That's a huge signal that they're thinking like owners and acting in the best interest of the shareholders, not just lining their own pockets.
And this idea right here, this might just be the single biggest secret to his success. We think of investing as this world of frantic trading and nonstop action,
But his world isn't like that at all. It's actually made up of long, quiet periods of just reading and thinking. And that's followed by very rare, very decisive moments of action. See the math part? That's actually the easy part. The hard part, the thing that really separates the winners from everyone else, is having the emotional discipline to just sit there and patiently wait for the perfect moment.
So that leaves us with one final, pretty big question to chew on. You could argue that Buffett's single greatest tool is patience. His whole philosophy is built on a temperament designed for the long game. But let's be honest, in our world of high-speed trading, instant information, and 24/7 news cycles, is his approach even possible anymore for the average person? Is that simple ability to just wait becoming a lost art? It's definitely something to think about.
All right, let's kick things off with a fantastic little story from the great investor Benjamin Graham. I love this one because it just perfectly captures the wild, often totally irrational world of market psychology, and how even the smartest people can get swept up in the herd. Okay, so picture this. An oil prospector gets to heaven, right? He's met by St. Peter, who's got some bad news. He says, "Look, pal, you're welcome here. But the section for oil guys is completely full. We've got no room." The prospector, he thinks for a moment, and then he asks St. Peter if he can just say 4 words to the guys already inside. So he cups his hands around his mouth and just yells, "Oil discovered in hell." And what happens next is just, well, it's incredible. The gates to the oilmen's compound swing wide open, and every last one of them comes stampeding out, heading straight for hell, absolutely desperate not to miss out on this new find. St. Peter is just blown away, right? He's so impressed. He tells the prospector, "The place is all yours, pick any spot you like." But the prospector, he hesitates, and then he says, "You know what, I think I'll go along with the rest of the boys. There might be some truth to that rumor after all." I mean, isn't that perfect? Even the guy who started the rumor gets caught up in his own hype. That is herd mentality in a nutshell. And that story, that's really the perfect way to get into what we're talking about today. The manic, depressive nature of the stock market. Because, just like that stampede for hell, the market is driven by these huge, powerful swings of emotion that can catch anyone, even the most rational among us, completely off guard. So here's the thing you've got to understand. The market isn't some cold, logical, calculating machine. No, it's a psychological battleground. And the secret to winning, like that old saying goes, is to be the counterbalance. You have to be greedy when everyone else is terrified, and you have to be fearful and cautious when everyone else is just euphoric. And here's the crazy part. This is not a new thing. Technology changes, right? Economies evolve. But basic human nature, it stays pretty much the same. We have literally centuries of data on market bubbles and crashes, and yet it seems like most people learn absolutely nothing from it. That's why looking at financial history isn't just some boring academic thing to do. It's one of the most valuable tools an investor has. Okay, so let's jump in and see how this isn't just a problem for our times. This cycle of greed and panic, it's a story that's played out over and over in almost the exact same way for hundreds of years. I mean, it doesn't matter if you're talking about tulip bulbs in the 1600s or trading companies in the 1700s or the hot tech stocks of the 1960s. The shape of the bubble is always eerily the same. You get that incredible rocket ship of euphoria followed by a just devastating collapse. It's a fundamental pattern, It's like it's hardwired right into our collective psyche. Let's start with the tulip bubble. We're in Holland, 17th century. People were literally trading their houses and their entire life savings for a single rare tulip bulb. I mean, the price for some of these bulbs was more than a luxury car costs today. It sounds completely insane to us now, but you have to remember, for the people caught up in it, it felt totally logical. Okay, fast forward about 100 years to England. Now we've got the South Sea Company. The government gave it a monopoly on trade with Spanish colonies, and the promise of these unimaginable riches sent the stock price into the stratosphere. Everybody from lords to laborers poured their money in, convinced this was the one thing they couldn't possibly miss. And this is where it just gets completely nuts. At its absolute peak, the South Sea Company was valued at £500 million. Now get this, the total amount of actual cash, coins, bills, whatever, circulating in all of Europe at the time was only about £100 million. So the value of this one company was 5 times more than all the money on the entire continent. I mean, it was pure make-believe. And what happened next? Well, it was as predictable as the sun rising. It was catastrophic. When reality finally bit, that bubble popped. The stock just collapsed, wiping out countless fortunes practically overnight. It fell a jaw-dropping 88% from its peak. A tough lesson in financial gravity, for sure. Now, what's incredible is that at the exact same time, right across the English Channel in France, almost the exact same thing was happening. This time, the bubble was built around the Mississippi Company, which had a monopoly on trade with North America. The story was identical. Infinite promise, a charismatic guy in charge, and a stock price that just laughed in the face of logic. And if you can believe it, the crash in France was even worse. The stock plummeted from a high of 18,000 livres all the way down to just 200. That's a 99% loss. It was almost a total annihilation of wealth, all built on nothing more than a shared dream and a whole lot of hype. All right, let's jump forward a couple hundred years to the 1960s in the good old USA. Why? Because the same pattern shows up again, just with a different coat of paint. In what they called the go-go years, the market was going absolutely wild for new technology companies. The whole story was about finding the next IBM or the next Xerox, and people were willing to pay literally any price to get in on it. And a company that really just perfectly captured the spirit of that era was National Student Marketing. It was this hotshot conglomerate with a super charismatic leader promising the moon. And the stock? It soared to $140 a share. Before, you guessed it, the inevitable crash brought it all the way down to $3.50. Same story, different century. Okay, so we've looked at this historical pattern of just madness. It's crystal clear that this cycle of boom and bust isn't something we left in the past. It's gonna happen again. So that brings us to the most important question, right? What can you, the individual investor, actually do about it? Well, the good news is you don't just have to be a victim of the crowd. The source material actually lays out a really clear, powerful playbook for turning all this market psychology from your worst enemy into your greatest ally. It's all about building a kind of mental fortress to protect yourself from the madness. And here's the blueprint for that fortress. First, you've got to adopt a 5-year mindset. Ask yourself this really powerful question. Would I still buy this stock if I knew the market was going to shut down for the next 5 years? See, that little thought experiment forces you to think like a business owner, not just a gambler. Second, you have to turn off the noise. Ignore the endless predictions, the chatter from the media, from your family, from your friends. Focus on the actual business, not the squiggly line on the screen. And third, and this might be the most important of all, you have to cultivate independent thinking. Do your own homework. Do it so thoroughly that you build an unshakable confidence in your own analysis, no matter what the rest of the herd is doing. All of this really leads to one critical understanding. In investing, your biggest opponent isn't the market, it's not Wall Street, it's not the economy. Your biggest opponent is the person you see in the mirror. It's a battle against your own hardwired instincts. You know, near the peak of every single bubble throughout history, you always hear the four most dangerous words in investing. This time is different. People start talking about a new economy, a new paradigm where the old rules of valuation just don't apply anymore. Let me tell you, that is one of the biggest red flags you will ever see, because the fundamental principles, things like profitability, a strong balance sheet, a sensible price, they're timeless. They were true in the 1700s, and they'll be just as true in the 2100s. And that is the ultimate reward for winning that inner battle. If you can develop the mental toughness, the guts, really, to be a buyer when the headlines are screaming sell and everyone around you is just panicking, you set yourself up for enormous long-term success. That's the real contrarian's edge. So I'm going to leave you with a question to chew on. It's easy to talk a big game and say you'll be brave when the markets are calm and everything's going up. But when that moment of truth really comes, when the headlines are screaming, fear is everywhere, and your own account is bleeding red, what will you actually do? Your answer to that question, well, that's what's going to define your entire investing journey.
So you're probably pretty comfortable investing in your own backyard, right? But what about everywhere else? In today's world, it's all connected. Looking overseas for investments, it can feel like you're stepping into this whole new world. A lot of potential for sure, but also a lot of things that can trip you up. So today, we're going to draw a map for that journey.
You know, there's this great quote from the poet John Milton. He wrote it hundreds of years ago, but wow, does it hit home for investors today. Our country is wherever we are well off. Think about that. Being well off, it's not just about your zip code. It's about making the right calls to build your wealth, and sometimes the best calls are waiting for you on the other side of an ocean.
And that's the big question, isn't it? The world's a big place. How do you find where you're going to be well off without getting totally lost? The options are just endless. And every market, every country has its own quirks, its own risks. You get it right, it can be amazing. But one wrong turn, yeah, that can really hurt. So how do we figure this all out?
All right, so here's our game plan for this explainer. We'll kick things off with why global investing is so tempting. Then we'll cover the one rule that applies everywhere. After that, we'll get into the weeds on foreign market risks, how to hunt for bargains, a neat little shortcut called the ADR, and we'll wrap up with the single most important idea to keep in mind. Let's dive in. Okay, first up, the allure of global investing. The world is your market, so why even bother looking outside your own country? What's the big pull?
Well, the biggest reason is just access. The internet, it's completely changed the game. It's torn down all the old walls. I mean, think about it. It wasn't that long ago that if you wanted to invest in some company overseas, it was a huge, expensive headache. Something only the big guys, the institutions, could do. But now, any one of us with a laptop can be a global bargain hunter. But, and this is a big but, that power works both ways. It also means it's easier than ever for people to get in over their heads and lose a ton of money.
All right, let's move on to something really important. One universal investing rule. This is the foundation, the thing that's going to keep you grounded no matter where you put your money.
Okay, this is probably the single most important thing to get your head around. The basic rules of smart investing, they don't change. It doesn't matter if you're buying a stock here at home or on the other side of the planet. The core principles are exactly the same. You still have to ask, is this company worth what I'm paying? Do I actually get what this business does? And am I getting it for a good price with a margin of safety? Same questions every single time.
And look, this is where a lot of people get into trouble. It is so easy to fall for "it's different this time" or "it's different over there" trap. The classic case study is Japan back in the day, right? Everyone was saying these crazy high PE ratios were totally normal for Japan. That's just how it worked. But no, that wasn't some new law of financial gravity. It was just a massive bubble. And telling yourself otherwise is a really expensive form of self-deception. Okay, so if the rules are the same, then what's actually different? Let's talk about navigating foreign market risks, because this is where the map gets a little tricky. There are definitely some warnings here. First off, let's just look at the sheer scale of the opportunity. 85%. That's how much of the world's population lives in what we call emerging markets. The growth potential there can just blow away what you see in more developed countries. And that's the siren song, right? That's what pulls in all that investment money. But, and you knew there was a but coming, you have to be extra careful. Be suspicious, because where there's huge potential for growth, there's usually huge potential for things to go wrong. It's not a place to be naive. So what kind of dangers are we talking about? Well, for starters, the accounting can be murky. You might not be totally sure who's even in charge of the company. The political situation could change on a dime. And yeah, in some places, think about the former Soviet Union, there's a real risk the government could just step in and say, "Thanks, those resources are ours now." It doesn't mean you stay away, but man, you have to go in with both eyes wide open.
Another huge one is currency risk. This one trips a lot of people up. Your stock could be doing great in its local currency, but if that currency tanks against the dollar, you could still end up losing money when you convert it back. Now, the big institutional players, they use something called hedging, which is basically like buying insurance against those currency swings. So why don't we all just do that? Well, for a value investor, hedging can be a real problem. Think it through. You buy a stock because it's cheap, and your plan is to wait, maybe for years, until the market catches on. But if you're paying for this insurance policy the whole time, month after month, year after year, those costs add up. It's like a slow leak that can drain away all your potential profits before you even get there. Okay, so with all these warnings, how in the world do you actually find a good deal? Well, now we're hunting for global bargains, and the secret is looking where other people aren't. It's a pretty simple concept, really. When a market is hot, when everyone's talking about it and piling in, prices get bid up, valuations get stretched. The potential bargains, they're usually hiding in the markets that nobody's talking about, the ones that have been unpopular for a while. It's no guarantee, of course, but it's a darn good place to start looking for a sale. And here's something really interesting, a potential edge for you. The whole discipline of value investing, it's really an American thing for the most part. It's most common here. So when you take that playbook, that same focus on fundamentals and margin of safety, and apply it to markets where everyone else is just chasing trends, you can find some incredible opportunities that the locals are just completely missing.
Okay, next up, let's talk about a practical tool to make all of this a bit easier. It's the ADR a simpler path. This is your stepping stone to global markets.
So what is an ADR? It stands for American Depository Receipt. The easiest way to think about it is like this. It's a certificate that trades on a U.S. stock exchange, like the NYSE, but it acts as a stand-in for shares of a foreign company. So you're not technically buying the stock on, say, the Tokyo Exchange. You're buying this US-based wrapper for it.
And the benefits are pretty great. First, everything's in US dollars. You buy in dollars, you sell in dollars, you get your dividends in dollars. No messy currency conversions. But the biggest advantage by far is safety. Because they trade here, they have to play by our rules. They're regulated by the SEC. That gives you a layer of oversight and protection you just don't get when you're buying directly on some overseas market.
Okay, we're at our last section. And honestly, if you take away just one single thing today, make it this. This is the ultimate investing mantra. Company, not country.
This is so important. You buy stocks in a company, not in a country. You never, ever buy something just because China is hot or Brazil is the next big thing. That's how you get burned. The crowd is almost always late to the party. You have to tune all that noise out and focus on the business itself. Is this a great company? Is it run by smart people? And is it on sale? That's all that matters.
So I'll just leave you with this one final thought. The next time you're looking at a foreign stock, ask yourself, what am I really seeing here? Am I seeing a flag? Am I getting swept up in the big story about a country's economy? Or am I seeing a balance sheet? Am I looking at the nuts and bolts of the business? Because how you answer that question, that's probably going to define your entire career as a global investor.
All right, let's talk about investing in technology. Just saying those words can make your stomach clench a little bit. It feels like this high-stakes game, right? You're trying to predict the future, and it's all about these huge, soaring highs and these absolutely terrifying lows. We're always told there are only two options. You're either a wild speculator just throwing money at things, or you have to sit on the sidelines and miss out on everything. But what if there's a third way? A smarter, more defensive way to play the game? Well, that's what we're going to dig into right now in this Tech Investors Playbook. You've heard this a million times, I'm sure, especially if you follow sports. And it is just a powerful, powerful truth. A flashy offense, yeah, it gets the crowd on its feet. It's exciting. But a solid, reliable defense, that's what actually brings home the trophy at the end of the season. And what's so fascinating is that this exact same idea applies perfectly to the world of investing, especially when you're trying to navigate the choppy waters of the tech sector. And that really is the million-dollar question, isn't it? When a company's stock price seems completely untethered from its actual profits, when the whole sector seems to move on nothing but pure hype, how in the world do you build a defensive strategy? How do you protect your money while still getting a piece of one of the most powerful growth engines in our economy? That's exactly what we're going to break down. Okay, so to build this playbook, we first have to really get our heads around the core problem. And the problem is something I call the tech stock paradox. It's this fundamental clash between how we're all taught to find good, solid investments and the reality of what most of these high-growth tech companies actually look like. This slide just lays it out perfectly. Look, on the one side, you've got your classic value investor. What are they looking for? A business they can understand, right? A reasonable price-to-earnings ratio, a track record of actually making money, some basic stability. But then you look at the right column, at the world of tech. And what do you see? Business models that are incredibly complex, valuations that are frankly insane. A lot of them have never turned a single dime of profit. And stability? That's the absolute last word you'd ever use to describe them. So here's the bottom line. If you stick to those old school investing rules, the ones your grandpa taught you, you're going to end up disqualifying almost every single exciting technology company out there. And it leaves you with two awful choices. You either have to throw your principles out the window and start gambling on hype, or you stick to your guns and risk missing out on decades of massive innovation and growth. It's a really frustrating paradox. But the good news is there is a way through it. And the way through that paradox, it starts with a disciplined philosophy, a mindset that knows how to find real value where other people only see chaos. This strategy has a name, and it's called GARP, which stands for Growth at a Reasonable Price. So think of GARP as the bridge that connects that old world of value investing with the new world of tech growth. It is not about buying cheap, broken companies, and it's definitely not about chasing after super expensive hype. It's all about finding that sweet spot. You're identifying these fantastic companies that have real growth ahead of them, but And this is the key, you're only pulling the trigger after the market gives you a fair or maybe even a bargain price to get in. So you're probably asking, okay, when do these amazing opportunities actually show up? Well, it's almost never when the market is euphoric and everything's going up. The real opportunity comes during the downturns. Think of a recession or a market crash as a stress test for every company out there. It's what separates the wheat from the chaff. It reveals which companies were built on a solid foundation and which were just flimsy houses of cards built on hype and easy money. And this is exactly how it unfolds. First, fear takes over. The market panics and prices for everything, the good, the bad, the ugly, they all just get hammered. Then, step 2, the weak companies, the ones that never really had a business model to begin with, they just can't survive. They falter, they go out of business. But then the third step happens. The truly strong companies, they prove their mettle. They just keep growing even when things are tough. And that is your moment. That's when the door opens and you can buy incredible, resilient growth at a genuinely reasonable price. Now, this isn't just some abstract theory. There are legendary investors who built their entire careers on exactly this kind of defensive, smart strategy. And one of the true masters of this approach was a man named Ralph Wenger. Ralph Wenger, he might not be a household name like Warren Buffett, but believe me, among professional investors, he was an absolute giant. He was famous for his incredible skill in picking winning smaller companies. In fact, there's a great story. USA Today once asked a group of top-tier investors who they'd want to manage their own money. Wenger won. He even beat out Buffett himself. That's how respected he was. And this number right here, this tells you exactly why he was so respected. A single $10,000 investment in his fund back in 1970 would have grown to over $618,000 by 1996. I mean, that just shows you the incredible power of a brilliant defensive strategy, patiently applied over time. So what was his secret? This quote right here is the absolute key to his entire philosophy. Wenger's genius was that he would look past the obvious hyped-up product, and instead he would invest in the less obvious company that was essential for that product to even exist or to succeed. He wasn't out there chasing the gold rush. He was the guy selling the shovels. Let's look at a real-world example. In the early days of video games, right? Everybody was obsessed with which console was going to win the war. Was it going to be Atari or Nintendo or Sega? It was this brutal, bloody fight. Wenger, he ignored that fight completely. Instead, he invested in the software company, Electronic Arts. And his logic was simple. No matter which company won the hardware war, they would all need great games to play on their machines. Here's another perfect example. Think back to the 80s and 90s. Dozens of companies were trying to build the best personal computer. It was a tough, low-margin, super competitive business. But Bill Gates became the richest man in the world not by building the computer hardware, but by creating the one thing every single one of those boxes needed to run, the operating system. Microsoft controlled that essential, foundational layer. And just to prove this isn't some modern tech thing, Wenger himself used to point back in history. In the 19th century, the big hype was the railroads connecting America. But building and running a railroad? It was a terrible business. So many of those companies went bankrupt. So who were the real winners? The people who owned the land in a city like Chicago, which became a massive transportation hub because of the railroads. Their land values went through the roof. It's the exact same principle, just a different century. So let's bring all this home. Let's put it all together into a plan that you can actually use. How do we combine the discipline of GARP investing with the genius of the Wenger way to create our own defensive playbook for today's market? Okay, here it is. Your defensive playbook broken down into 5 clear steps. First step, you leave the high-risk gambling to other people. Let them do it. Second, you use those market downturns as your opportunity. You wait for them patiently. Third, you identify the big, undeniable trend, the core innovation that everyone's excited about. Fourth, and this is the critical Wenger step, you look past the hype and you find the shovel sellers, those essential companies that benefit from the trend without taking on all the direct risk. And finally, step 5, you invest in those durable sideline businesses and you hold them for the long term. Because you can be absolutely sure of one thing. The next massive wave of technological innovation is always just around the corner. Maybe it's AI, maybe it's biotech, maybe it's something we can't even imagine right now. So the question this playbook leaves you with is a simple one. When that next gold rush kicks off, are you going to be one of the thousands of prospectors out there digging frantically for a few little flecks of gold? Or are you going to be the smart, patient investor who owns the company that's selling them all the shovels?
All right, today we're going to pull back the curtain on a part of the market that, a lot of people overlook, but it's absolutely packed with potential. We're talking about small companies. And what we're going to do is build a playbook, a real step-by-step guide to help you understand the unique power these businesses have and, more importantly, how you can approach them as an investor. So, let's get into it.
You gotta love this quote from the legendary investor Ralph Wenger. He said, "Dumbo could fly because he was a baby elephant. Adult elephants are aerodynamically unsound." It's brilliant, right? It just perfectly captures the whole spirit of small cap investing. It's not about weakness, it's that a company's small size is its actual superpower. Just like Dumbo, that smallness is what gives them the potential to fly, to achieve incredible growth that's just, well, physically impossible for those giant aerodynamically unsound corporations.
And this right here, this visualizes Wenger's point perfectly. Just take a look. On one side, you've got a giant, a behemoth like General Motors. You think they can double or triple their sales in a single year? I mean, come on, it's practically impossible. The sheer scale of the operation makes that a non-starter. But then you look at the other side, a small, nimble software company. Can it triple its sales? You bet it can, and that explosive potential is exactly what we're here to talk about. It's the engine that can make a stock price multiply in a way a huge company's stock just can't.
So here's the game plan for this explainer. We're going to kick things off with the basics, the small cap advantage. Then we'll get right into the hands-on playbook with the 5 golden rules. After that, we'll sprinkle in some wisdom from a master with Wenger's winning formula, talk about the crucial mindset you need for the long game, and then wrap it all up by looking at the 3 paths to profit.
Okay, first things first, the small cap advantage. Let's really nail down why being small can actually be a massive superpower in the world of investing.
So the whole idea really boils down to this. It's all about the runway for growth. A small company, see, it's operating in a market it hasn't even come close to saturating yet. It can innovate faster, it can pivot on a dime, and it can grab new customers at a speed that those bigger, more bureaucratic companies, well, they can only dream of that kind of agility. And that, right there, is the fuel that can make its stock price absolutely go through the roof. Okay, so that covers the why. Now let's get to the how. It's time to move on to our next section, the 5 golden rules. I want you to think of this as your essential playbook, your guide to navigating the small cap market not just effectively, but safely. And this really gets to the heart of the matter, doesn't it? It's the big question every single investor faces in this space. With all that incredible potential for growth, there's also risk. No doubt about it. So how in the world do you find the winners? And just as importantly, how do you avoid the blow-ups? The answer is discipline. It's a rules-based approach.
Rule number 1. And listen, this one is completely non-negotiable. Demand financial strength. For any company, sure, you check the finances. But for a small company, it is absolutely vital. They don't have those giant cash cushions to fall back on. So here's a simple tool. Look at the debt-to-equity ratio. You want to see that number at 50% or less. This isn't just a friendly suggestion, it's a critical safety check. It ensures the company isn't already drowning before it even gets a chance to swim.
Next up, rule number 2. We're looking for above-average growth. I mean, this is the whole reason we're interested in small companies to begin with, right? We want businesses that are expanding fast. But, and believe me, this is a huge but, you cannot let yourself get swept up in the hype and overpay. The real skill is finding that incredible growth at a reasonable price. That price discipline, that's what separates a smart investment from just a speculative bet.
Now for rule number 3, and this one is so important, proven profitability. You must avoid companies that have never actually made a profit. Let me say that again, because it matters. Never invest in a company that hasn't proven it can actually make money. Sticking to this simple rule draws a very bright line in the sand between 2 totally different ways of operating in the market. And this slide makes that line crystal clear. You've got 2 camps. An investor buys a piece of a profitable, functioning business. A speculator, on the other hand, is basically betting that an unprofitable company might, someday figure out how to be profitable. That is a completely different game with a completely different set of risks. Our playbook, it's for investors.
Okay, let's talk about rule number 4. Diversify your bets. Look, it's just a fact that small companies can be more volatile. They can have bigger swings. So you need to spread your risk out more than you would if you were just buying a handful of big, stable, blue-chip stocks. Now, how many is the right number? That's up to you. But the principle is what's key here. Please, don't put all your eggs in one small, high-growth basket.
And here we are, the final golden rule, number 5. You have to play the long game.
This is not a strategy for making a quick buck. It's not for day traders. Unlocking the real true potential of a small company takes time. It takes patience to ride out the inevitable market swings and a genuine long-term perspective to let that growth story actually play out. If you're not ready to hold on for the ride, this isn't the strategy for you.
So we've got our 5 rules. That's our foundation. Now let's add a layer of genius from the man who started us off, Ralph Wanger. This is his winning formula for finding the best of the best.
Wanger's whole philosophy really boils down to these 3 things. First, he hunts for a company that has carved out a unique niche for itself. This could be some kind of tech advantage, or it could be as simple as just being a little bit smarter at marketing than everyone else. Second, just like in our rules, he demands strong finances, no exceptions. And third, and this is such a great insight, he looks for entrepreneurial management.
So, what on earth does he mean by entrepreneurial management? This slide says it all, really. In a huge company, you're usually dealing with an employed CEO, a professional manager. But in a small company, you can often talk directly to the owner, the founder. They have their own money, their own reputation on the line. Their passion, their vision, that personal stake in making it succeed, that's an incredibly powerful force working in your favor.
And that idea of vision brings us right back to that crucial theme of patience. So let's dig a little deeper into what the long game really means and talk about both the timeline you should expect and some of the pitfalls you definitely need to watch out for.
This timeline is all about setting realistic expectations. In your first year or so, honestly, you should just expect volatility. The market's going to do what the market does. It'll bounce around. But as you start pushing into that 3-year mark and beyond, you give the company's strategy real time to take hold and for its numbers to improve. It's really over that 5+ year horizon that the true, game-changing growth can finally be realized. Patience isn't just a virtue here, it's a necessity.
Now let's talk about a major pitfall, and this is a direct warning you need to take seriously: liquidity. Some small company stocks are, well, they're thinly traded. Not a lot of shares change hands each day. This might not seem like a big deal when you're excited and buying in, but trust me, it can become a massive headache when you want to sell. If there are no buyers, you could get stuck or worse, be forced to sell at a terrible price just to get out. You have to be aware of this risk going in.
Okay, so you've done the work, you followed the rules, you've been patient. You found the real winner. So how does it all pay off in the end? Let's look at the final piece of our playbook, the 3 paths to profit.
So there are really 3 main ways you can win big here. The first is just plain and simple growth. The company executes its plan, it expands, its earnings grow, and that drives the stock price up. Simple. The second path is revaluation. This is when the rest of the market finally wakes up and realizes what a gem this company is, and they bid the price up to reflect its true value. And the third path? The takeover bid. This is when a larger company sees the same value you did and just decides to buy the whole thing, often at a really nice premium.
And that's really the beauty of this whole strategy. As the quote says, there is more than one way to get a return from a small company. When you follow a sound, disciplined strategy, you put yourself in a position to win, no matter which of these positive outcomes happens.
So let's wrap this all up and recap the key takeaways from your new playbook. First, always focus on financial strength. That debt-to-equity ratio is your best friend. Second, demand proven profitability. Be an investor, not a speculator. Third, diversify your holdings to manage that risk. Fourth, think long-term. We're talking years, not months. And finally, keep an eye out for those niche leaders, the ones with that entrepreneurial fire.
We've covered the why and the how, from the core rules all the way to expert strategies. The playbook is officially in your hands. So really, the only question left to ask is, with this new framework, which small cap niche are you going to start exploring first? Thanks for joining me for this explainer.
All right, let's dive right in. Today, we're going to talk about something that's the bedrock of a lot of people's financial lives: mutual funds. You know, they're often sold as the perfect, simple starting point for investing. But here's the thing the source material for this explainer really wants us to grapple with. Are we actually taking them seriously enough? Are we asking the right questions? Because the argument we're about to explore is that for most of us, the answer is a big and potentially very expensive no. Let's find out why. And man, the source we're digging into today does not pull any punches. It kicks off with this killer line from Gordon Gekko. Now, yeah, he's a movie character, but that quote just cuts right to the heart of a huge problem in finance: the herd mentality. It's a warning, right? Don't just follow the crowd. Don't assume the person managing your money is some kind of genius when they might just be another sheep in the flock. This quote, it sets the perfect tone for what we're about to do. We're going to stop being sheep and start being investigators. So that Gecko quote leads us right into the big myth we need to bust today. And that's the idea that mutual funds are the simple, set-it-and-forget-it investment for people who don't want to think too much. I mean, it sounds great, doesn't it? In our crazy busy lives, just hand over the money and let a pro handle it. But what our source says is that this way of thinking isn't just a little off, it can be a trapdoor for your money. You know the drill. You've seen the ads, you've read the pamphlets. The pitch is always the same. Too busy to research stocks? Not an expert? Hey, no problem. A mutual fund is your all-in-one solution. It's sold as the safe, responsible thing to do. But here's the mind shift our source material insists on. You're not just buying a product off a shelf. You are hiring an employee. And let me ask you, would you ever hire someone for a critical job without even doing an interview? And this is what happens when you don't do that interview. This isn't some abstract risk we're talking about. It's deeply personal. Just think about it for a second. Your pension, the money you busted your butt for decades, the money that's supposed to be your security blanket later in life, could end up in the hands of some 25-year-old kid whose grand investment strategy is basically, I don't know, mobile internet seems kind of cool. This example is designed to be a wake-up call. It's a gut check. Okay, so how do we avoid that nightmare scenario? How do we stop being a passive customer and start acting like the boss? Well, the source gives us a really powerful tool, a 5-point inspection. This is your interview process, this is your checklist, and these are 5 absolutely non-negotiable questions you need solid answers to before you trust a fund with even $1 of your money. So let's walk through them one by one. First things first, we start with the person, the human being who's actually making the calls with your money. Forget the charts, forget the marketing hype for just a minute. Everything, and I mean everything, flows from the person who's in charge. And that brings us to question 1 on our inspection list. What are the merits, the qualifications of the current fund manager? Now, that sounds pretty obvious, but here's the classic mistake. We look at a fund's 5-year performance and just assume that's the manager's resume. But as you're about to see, that can be a really, really flawed assumption. And this is where we have to become real detectives. Think about it. A fund's amazing 10-year track record means absolutely nothing if the genius who earned it packed up and left 6 months ago. That performance walked right out the door with them. So you have to ask, has the manager changed? If the answer is yes, then you're investing in the new manager, and you have to dig into their history. What's their record? Where did they come from? Remember the key point here. You are paying a fee for skill. This is a service. Your expectations should be incredibly high. So let's move on to the second question, which flows right from the first. Okay, you've checked out the manager. They seem like a pro. Great. But the next step is just as crucial. It's about their philosophy. It's not just who they are, but how they think. What is their actual game plan for investing? And this is where our source lays down a really hard and fast rule. This isn't about a pretty good fit. You're looking for a perfect match. For example, if you're a conservative investor who likes to buy solid, undervalued companies, it makes 0 sense to hire a manager who just chases hot, expensive tech stocks. Because as soon as the market gets rocky, you're going to be panicking while they're doubling down. Your goals and their actions will be completely out of sync. So if their strategy doesn't mirror your own, the source is clear, walk away. That fund is not for you. End of story. All right, so we've interviewed the driver, we know who's behind the wheel, and we like their driving style. So what's next? Well, now it's time to pop the hood and see what kind of engine this thing is really running. What is the fund actually made of? This brings us to question 3, and it's a big one. Which specific stocks does this fund own today? A mutual fund isn't some kind of magic black box. It's just a basket, and inside that basket are real companies. You need to know what's in that basket right now, not what was in it a year ago. And here's the bottom line. If that basket is filled with a bunch of ridiculously overpriced, overhyped stocks, then guess what? The whole fund is overpriced and overhyped. There's no magic that protects you. Buying a popular, expensive fund is no different from buying a popular, expensive stock. The source is adamant about this. You can't just outsource your thinking. You have to look at the top 10 or 20 holdings and ask yourself, does it make sense to buy these companies at these prices? You have to form your own opinion. And now for questions 4 on our inspection. This is a risk that so many of us completely forget to even think about. So picture this. You've done all the work. You found a brilliant manager, you love their strategy, you agree with the stocks they own, it's perfect. And then, next Tuesday, they get a better offer and quit. What happens then? The pros call this key person risk. And trust me, it's a huge deal. The whole reason you invested was because of that specific person's talent. If they walk out the door, there's absolutely no guarantee that their replacement thinks the same way or is even half as good. The name of the fund stays the same, but the entire strategy, the engine, could be swapped out overnight, and you might not even realize it. You need to know if the company has a deep bench and a consistent philosophy that can survive one star player leaving. Okay, we've covered the person, the philosophy, the portfolio, and the backup plan. We're now at the final stop on our inspection. And this one, well, it might be the most counterintuitive part of this whole thing. Let's talk about the cost. So here we are, at our fifth and final question. What are the fees? Seems simple, right? Well, get ready, because the answer our source gives us goes against almost everything we've been taught about mutual fund fees. Okay, brace yourself, because this is a real plot twist. For years, we've had one idea hammered into our heads. Fees are bad, and your number one job is to find the fund with the lowest possible fees. Well, the source we're explaining today says that's not just wrong, it's a colossal mistake. Making low fees your top priority is a recipe for mediocrity. So, what's the logic here? It's actually just free market common sense. If a fund's main selling point is just that it's cheap, you might be accidentally picking a manager who doesn't even believe they can beat the market. Think about it in any other part of your life. You don't look for the cheapest surgeon, you look for the best one you can afford. The source argues investing is no different. A truly skilled manager is providing a premium service, and it's totally logical that they'd charge a premium fee for it. And you know the ultimate sign of a confident manager? They're willing to tie their pay to their results. A performance fee means they only get paid really well when you make a lot of money. Now that is an alignment of interests. Now, after making that really strong case for paying for quality, the source is very careful to point out one massive exception to this whole way of thinking. And understanding this difference is absolutely critical. And that big exception is the index fund. This is a completely different animal. An index fund isn't run by a star manager trying to be a genius stock picker. No, it's a passive fund, usually run by a computer, and its only job is to copy a market index, like the S&P 500. It doesn't try to beat the market, it just tries to be the market. And this table just makes it crystal clear. With an active fund, you're paying for a human's skill. The goal is to beat the market, so you should be willing to pay for quality. With an index fund, there is no human skill. It's a computer just matching the market. So the logic on fees completely flips. For an index fund, since it's a commodity, your one and only job is to find the one with the absolute rock bottom lowest fee you can find. So who should buy index funds? Our source is very direct about this. It says they're for the person who really isn't interested in investing. And look, that's not an insult, it's just a description. If you've listened to this whole 5-point inspection and you're thinking, man, I have zero interest in doing any of that work, then an index fund is a perfectly rational, perfectly smart choice. It's a passive tool for a passive investor. And that brings us right back to where we started. This whole explainer has been about one thing: shifting your mindset, understanding that choosing a mutual fund isn't a simple purchase. It's a massive act of delegation and trust. After going through these 5 questions, it should be pretty clear that you're hiring someone to manage your future. Your money, your retirement, your family security, it's all on the line. So the question I want to leave you with is a personal one. Are you asking the right questions? Hey everyone, and welcome. Today we are going to get into something that's, well, absolutely crucial for your financial future. We're going to build an investment style that isn't just about making money, it's about making it last. This is all about cutting through the noise, the hot tips, and forging a strategy that is uniquely and powerfully yours. You know, I love this quote from Benjamin Disraeli because it just cuts right to the chase. Look, successful investing isn't really about some lucky break or chasing a stock that's going to the moon. It's about having what he calls a constancy of purpose, a clear, steady strategy that you stick with, one that guides you through the market's, well, its inevitable craziness. That idea? That's our foundation for everything we're talking about today. So before we start looking forward, let's actually take a quick peek in the rearview mirror. Just for a second, think about it. Where were you financially 10 years ago? What was the economy like? What were people worried about then? Honestly, understanding our own journey is the absolute best place to start when we're trying to map out the road ahead. And that leads us perfectly into our first section, lessons from the past. We're not here to beat ourselves up over mistakes. No way. We're here to get smarter. We're going to dig into those past experiences and pull out the invaluable lessons that, believe me, create truly intelligent investors. And you know what's wild when you look back? You start to see a pattern. Markets really do move in these huge emotional cycles, from total fear to absolute greed, and then right back again. You can see it right here. The depressive, kind of gloomy mood of the early 90s just explodes into this manic, anything-goes frenzy of the late 90s. And then, pop, the internet bubble bursts. Now, while it felt like a total shock to a lot of people, a seasoned investor could see the warning signs of that mass delusion from a mile away. For everyone else, well, it turned into a very, very expensive but important lesson. And that right there is the key. If you lost money back then, it's so easy to just chalk it up to bad luck, but it is so much more powerful to see it as paying tuition. You literally paid for a critical lesson about hype and speculation, and that's an education that can protect you for the rest of your life. All right, so let's boil this all down. Lesson number 1, bubbles are not a once-in-a-lifetime thing. They are a feature, not a bug, of financial markets, and they are driven by pure human psychology. They will happen again. Second, your absolute best defense is knowledge. It's exactly what you're doing right now. Third, the market system itself is incredibly tough. It can take massive hits and keep on going. And finally, and maybe the most important, fear is a terrible financial advisor. You have to learn to make rational calls even when your gut is screaming, because the world just keeps moving forward. Okay, so we've got those lessons from the past locked in. Now let's turn to what is, without a doubt, the single most powerful force in all of finance. We're talking about the magic of compounding, and I'm not exaggerating here. If there is one single concept that can totally change your financial life, this is it. You know, it's so easy to get swept up in the excitement of a bull market and think you need these spectacular 20% plus returns to get ahead. But that's the exception, not the rule. And the great news is, you absolutely do not need that. The real secret weapon is consistency. Because as you're about to see, even a few percentage points, when you apply them over time, can make a staggering, life-changing difference. This just lays it out so clearly. I mean, look at this. At a 4% annual return, your money doubles in about 18 years. Okay, not bad at all. But jump that up to a 12% return, and your money doubles in just 6 years. 6, that's 3 times faster. It's not just a little bit better, it's a completely different universe of outcomes, all thanks to that incredible power of compounding. It's a force so powerful that this quote is often attributed to Albert Einstein himself. Now, whether he actually said it or not, who knows, but the sentiment is 100% true. You don't have to be a genius to use it, but really appreciating its power, well, that's the mark of a truly intelligent investor. So, if compounding is the engine of our wealth-building machine, then what's the best vehicle to put it in, right? In this next section, we're going to compare the main tools for long-term investing to figure out which one is really built to go the distance. This is the classic question, isn't it? It's one of the most fundamental decisions every single investor has to make. You've got your savings, you've got a long-term goal, so where do you put that money to work so it does the most for you? Stocks or bonds? Let's get into it. Okay, let's break this down nice and simple. For long-term growth, I'm talking years, decades, history is crystal clear. Stocks are the undisputed champion. The trade-off, of course, is that you have to be okay with some short-term ups and downs. Now, with bonds, the big risk that nobody talks about enough is inflation, that silent thief that just eats away at your buying power. So the takeaway is pretty straightforward. Stocks should be your default setting for long-term goals. The main time to really consider bonds is as a kind of safe harbor when the stock market seems to have gone completely crazy and valuations are through the roof. So where do index funds fit into all of this? Well, they're wildly popular, and for a very simple reason. They are a totally reasonable alternative to paying a ton in fees to a fund manager who, let's be honest, probably won't even beat the market anyway. The stats don't lie. And that brings me to a critical warning. You are going to meet plenty of brokers and fund managers in your life. Please remember this. The ones who promise you the moon, the ones who guarantee incredible returns, that is a massive red flag. The bigger the promise, the more skeptical you need to be. It's that simple. All right, for our final section, let's learn from the best. You don't have to reinvent the wheel when it comes to investing. The world's greatest investors have literally left a trail of breadcrumbs for us to follow. The secret is just knowing how to find it. So how do you actually do it? It's not some big mystery. It's actually a pretty simple 3-step process. First, read what they read. Start with their book recommendations. Second, you got to get your hands dirty. Go download the same annual reports they're looking at and try to do your own analysis. And third, study their portfolios. Now this is key. You're not doing it to copy them, but to reverse engineer their thinking, to see how they put all their principles into practice. In this next point, man, this might be the single most important piece of advice we covered today. I really can't stress this enough. Do not just go out and buy a stock because you heard some famous investor bought it. That is a classic recipe for absolute disaster. Because the goal here isn't to be a copycat, it's to be independent. It's all about knowing exactly why you own what you own, and just as important, knowing your reasons for selling it. This is how you stop following the herd and start forging your own investment style, one that is built for you, your goals, and your personality. And that brings us right to our conclusion. We've looked at lessons from the past, we've talked about the awesome power of compounding, and we've peeked into the strategies of the masters. Now it's about pulling it all together and realizing the incredible advantage you now have. Aristotle Onassis once said, "The secret of business is to know something that nobody else knows." And that's exactly what you have now. Understanding these time-tested principles, the lessons of history, the math of compounding, the importance of independent thought, that is the something that most people in the market simply don't get. It's your edge. I mean, really think about that. While the crowd is chasing the latest hot trend, you'll be focused on real value. While they're panicking because of scary headlines, you'll be looking for opportunities. The knowledge you've picked up today is a real, tangible advantage. So for goodness sake, use it. And so we end up right back where we started, but now with a totally new perspective. This question, it's not just some abstract idea anymore. It's a call to action. Armed with everything we've talked about, what will your personal investment style be? All right, welcome. Today, we're going to take a journey, a kind of guided tour through what I think is the essential library for anyone who's serious about investing. We're not talking about hot stock tips or what's buzzing on the internet. We're talking about building a real, solid foundation of wisdom, the kind that actually lasts. So let's dive into the books that have literally shaped the greatest financial minds in history. You know, this quote right here, this is basically the price of admission. It's not about finding some secret formula nobody else has. It's about a deep, relentless commitment to always be learning. This one idea is the real starting point for everything else we're going to cover today. Because success in the market, it's a marathon of education, not some sprint for a quick buck. So I want you to think of this as your map. And the books we're about to explore, those are the crucial landmarks along the way. Your personal journey to becoming a smarter, more confident investor, well, it starts right here, right now. Now, before we can even begin to talk about the modern masters, we have to go back to the source. There's one book by one author that is the absolute bedrock of value investing. Seriously, if your investing knowledge is like a skyscraper, this book is the steel-reinforced concrete foundation holding the whole thing up. And here it is, The Intelligent Investor by Benjamin Graham. Let me be crystal clear about this. This is the non-negotiable starting point. If you decide you're only going to read one book on investing in your entire life, it has to be this one. It's not just a suggestion, it's practically a requirement. So why is it such a classic? Well, the genius of Graham is that he doesn't tell you what to think. He teaches you how to think. He gives you this incredible mental framework built on two powerful ideas. First, he introduces you to Mr. Market. Think of him as this moody, manic-depressive business partner who shows up every day offering to sell you his shares or buy yours at wildly different prices. Graham teaches you that you can and should ignore his crazy mood swings. And second, he gives you the ultimate weapon, the margin of safety. It's a simple idea. Buy a business for way less than you know it's truly worth. That gap, that margin, is what protects you when things go wrong. And check this out, 1949. Just stop and think for a second about everything that has happened in the world since 1949. We've had booms, busts, wars, the rise of the internet, you name it. And through all of that chaos, the principles in this book haven't just survived, they've triumphed. This isn't about fleeting trends. It's about timeless, unshakable wisdom. Okay, so once you've poured that concrete foundation with Graham, the next logical step is to see how those brilliant principles were actually put into practice in the real world. It's time to learn from the masters, to stand on the shoulders of giants. And really, who better to start with than Graham's most famous and successful student, Warren Buffett? This biography by Roger Lowenstein is so much more than just a life story. It is a masterclass in watching an investment philosophy evolve and adapt over decades of patience, hard work, and just incredible insight. What makes this book so fantastic is the depth you get. Lowenstein was a reporter for the Wall Street Journal, so he gives you the why behind the what. You really get inside Buffett's head, you see how he thinks, and you learn just as much from his mistakes as you do from his massive home runs. It's the perfect book to pick up once you feel you've got a handle on the basics from Graham. Now, for a wider lens, you've got to check out John Train's books. He profiles a whole range of investment legends. But here's the brilliant part. In both books, he includes a famous speculator. And this contrast is absolutely critical. See, an investor, in the tradition of Graham and Buffett, analyzes a business, buys a piece of it, and expects to profit as the business itself grows over the long term. A speculator? They're basically just betting on which way a stock price is going to wiggle tomorrow, often with zero regard for the actual business underneath. Understanding that difference is one of the most important things you can do to figure out who you want to be. All right, so you've learned the fundamentals, you've studied the masters, now the journey starts to turn inward. Because the goal here isn't to just become a cheap copy of Warren Buffett. The goal is to take all this incredible wisdom and use it to build a philosophy that fits you, your personality, your goals, your unique way of seeing the world. I mean, come on, how great is that title? A Zebra in Lion Country. It immediately paints a perfect picture of what the stock market is really like. It's a jungle out there. It's competitive. And this book, by the legendary fund manager Ralph Wanger, is basically your field guide to survival. Wanger's whole metaphor here is just so simple and powerful. As an individual investor, you're not the lion, you're the zebra. And you don't survive by trying to outmuscle the lions. No, you survive by being smarter, more nimble, and understanding the rules of the jungle. One of his key insights is to focus on smaller companies, the small caps. These are the nimble businesses that have a ton of room to grow, unlike the giant lumbering lions of the market. It's a really practical guide to finding your own little patch of the savanna to thrive in. So one of the best survival strategies in any jungle is to not run with the herd, right? When everyone else is panicking and running one way, you calmly walk the other. But what does that really mean when it comes to investing? What does it actually take to be a true contrarian? For that, we turn to David Dremin. This guy is one of the most respected, well-documented experts on contrarian investing out there. And his work isn't based on some vague gut feeling. It is backed by mountains of data. Decades of research showing exactly how and why going against the crowd can be an unbelievably profitable long-term strategy. And this is the core idea. Being a contrarian isn't just about being different to be different. It's a disciplined, systematic approach to finding incredible value where everyone else is too scared or too pessimistic to even look. Drummond's favorite tactic? He looks for good, solid companies that have just fallen out of favor with the market, often identified by having a low price-to-earnings ratio. He's exploiting the emotional overreactions of the crowd, a principle that Benjamin Graham himself would stand up and applaud. So, we have covered a lot of ground. We've laid that crucial foundation, we've learned from the absolute best in the business, and we've explored some very specific strategies. So now, let's pull it all together and build out your starting bookshelf. Okay. Think of this table as your personal toolkit. Take a second and think about where you are right now. Are you brand new to all this? Start with Graham. No debate. End of story. Do you have the basics down and you're ready to see what true mastery looks like in practice? Grab that Buffett biography. Do you find yourself always questioning the popular opinion? Well, Dremin is your guy. This isn't just a checklist to get through. It's a map to help you decide which road you want to take first. Because look, at the end of the day, all this knowledge is just potential. The real journey, your journey, doesn't start when this is over. It starts the moment you pick up one of these books, feel the weight of it in your hands, and turn to that first page. So the only real question left is, which one is it going to be?